Is there anybody? Nope, nobody else is sitting in the waiting room. So Tom is going to talk to us today, like I said, about demystifying social startup finance. I know that a lot of my students, when they're writing their business plans, go, oh, we'll just get money from a grant and we'll just put something on GoFundMe. And I go, I don't think that's how you do it. So Tom is going to tell us everything today that we need to know. So over to you, Tom.
Thanks so much, Leanne, and great to be here as a QSEC member. Presenting, I may be based in Sydney, but starts on good as a member of QSEC and love working with Queensland-based enterprises. Before I go further, I just want to share my own acknowledgement of country and that I'm joining you from the traditional lands of the Camaragal of the Eora Nation and pay my respects to elders past, present and emerging here and acknowledge that this land was never ceded. That might have been a little bit of an oversell. I'm not sure that I can tell you everything there is to know, nor would I even claim to be an expert at everything there is to know when it comes to startup funding. But I am keen, I guess, to help you think through the variety of options that exist and which may provide a potential pathway for you in terms of making the progress that you're seeking with your enterprise or idea. My goal is to present for maybe half an hour-ish, and then just for us to be able to talk for the second half, answer any questions that you do my best to answer any questions you have, and so on. So let me share my screen now. Here we are. So funding options for social enterprises. So before we go any further, you mentioned a couple, Leanne, but I'd love to just have a quick brainstorm. If you guys have access to the chat, let's do a couple of things there as we go. What are some of the options that you're aware of when it comes to social startups? Yep, personal funding. Yeah, true talk. That's the real talk. That is where often the investment in a new enterprise starts. Friends and family. Debt, equity. Yep. So to be clear, just to really break down all our terms, debt, obviously, someone's lending you money and expecting you to pay it back. And often, usually, to pay back more than they lent you, with interest. Equity means they're buying a share, a chunk of your company, and they are now a part owner. Family, friends, and fools is the classic first investors into all startups. Yourself, that's right, family, friends, fools, yep. Donations, that's for sure, part of the puzzle for a lot of social enterprises. Yeah, grants. Cool. Couple more that I might add that we'll talk about. There's challenges sometimes, like competitions of various sorts, idea competitions, innovation challenges, and so on. Also accelerators, some of them come with funding, etc. So look, we're going to talk through these and kind of where they lie. I saw someone present at a conference, this is a couple of years ago now, but they shared this graph while talking about funding options for social enterprises, which I want to share with you because I think it does a pretty good job across a particular spectrum. And that is from kind of traditional investment, for-profit investments on the left through to traditional philanthropic donations on the right, and then different flavors of blending those. So the next one is finance first. And so those are investments that expect the same return as general investments. They expect, in other words, kind of like normal mainstream, what you might call mainstream levels of return, but also try to prevent doing like real damage. That's your classic kind of ethical screen, not non-impact screen, ethical screen, trying to avoid tobacco or firearms or things like that. Then there's what we might think of as impact investing, which is focusing on companies who are not just not doing harm, not just avoiding certain harmful industries, but focusing on companies that deliver a social or environmental benefit while also developing competitive market rate returns. Then there's impact first, and that's meant to be where people do begin to compromise on those market rate returns in return for greater levels of impact. That's the true hybrid form. Then venture philanthropy, which is philanthropy, no repayment expected, but also don't come back for a future donation. It's philanthropy given with a kind of investor mindset that we want to give a we want to give a startup investment once. That could be a grant, but we're not here to try and create a granting relationship for all time, where your whole business model, your whole revenue model is that you will get more grants from us. You have to have a real revenue model that is capable of hopefully reaching sustainability through the grant. And then philanthropic donations. And this is a cool little spectrum here, and it is very interesting. There's a couple of things I want to say about it. The first is that what gets hidden when people present graphs like this is the differing degrees of availability of these different types of investments. You know, this is a nice conceptual graph of these different stages, but it doesn't imply that funding actually exists at these different stages. And in particular, what's kind of missing from this whole conceptual framework is a consideration, you know, the entire missing dimension that underpins all of these, I think, and that is relevant to all of us, is a consideration of risk. How ambitious, risk tolerant are investors at all those different categories? Because the truth of the matter is not very. And so right now in Australia, what we lack severely across this whole sector is risk tolerant capital. And that's true irrespective of which of those models you look at. The impact investors are no more adventurous than the traditional philanthropists at the moment. They're doing a slightly different thing, but they're doing it with very similar risk parameters, which is to say they like to take very little risk at all. The other thing to mention, I might go back to this graph just a little bit, is that we have almost no impact first impact investment in Australia. It's almost all finance first or impact investing, which is pro-impact, but provided competitive market rate returns are also provided. I use the word provided way too many times in that sentence, but you know what I mean? And so one of the kind of provocations that I often give to the impact investment industry at the moment is that we have impact investment in Australia, but we don't have impactful investment, because the impact investors will only invest in things that the non-impact investors would invest in anyway, because they are just straight up investable. Anything that's provided a market rate return doesn't in fact need impact investors to choose it. Just investors will take a company with a market rate return. So what I would say to them is, you know, tell me something you invested in that no non-impact investor would have invested in. And very few of them have an answer to that. Because right now what they're doing is this thing called impact investing that you see on the yellow bar. But to me, impactful investing is the green bar, is impact first. You have to be willing to invest in something because it creates impact that you wouldn't if it didn't. And we sadly lack for almost any of that at the moment. 96% of what it constitutes impact investment in Australia at the moment is in very low risk sectors. It's in property, it's in renewables with long-term supplier agreement in place. It's in impact bonds, in highly mature, very well proven impact models. There's almost none of it for startup social enterprises. And I think one of the great mistakes a lot of social entrepreneurs make is thinking that there are investors who will be interested in what you're doing anytime soon when you're starting out. There really aren't in most places. Now, having said that, you know, I've just been involved in a consortium that did raise some funding for a pre-launch social enterprise, but it was, you know, a really unique joint venture between multiple established social enterprises. So, you know, it's not to say nothing's impossible, but it's a really you know, it's a highly unlikely pathway for your emerging social enterprises. And so this is what leads to the kind of situation we see in the kind of impact investment or you know, capital for social enterprises at the moment, where we have a total mismatch between the supply of capital and the demand of capital in terms of what they're both looking for. Social enterprise, there's this enormous need in these early stages and up into these middle stages for social enterprises that are launching and growing. And then there's a massive supply of capital sitting out there complaining about a lack of pipeline because not enough, which is the people at the very top. And so, you know, it's where if you ever hear someone announce a new $100 million impact investment fund in Australia, it's not exciting, because they'll just be sitting alongside the other $100 million impact investment funds complaining about the lack of deal flow, because those funds have a logic to them that requires investing at a certain degree of funds to justify, you know, to be able to deploy the size of the fund. If you plan to invest $100 million, you want to do so in $1 million plus chunks. And if you're investing $1 million, you want to do a lot of due diligence to make sure that it's a good deal and that you really understand where you're putting your money. And if you're doing a lot of due diligence, that's very expensive. So that too means that you can't invest below a certain amount. So there's this, what gets called a missing middle in the finance market in Australia at the moment, which is where there's lots of options to get up to 50,000. And there's actually lots of options to get over $500,000, but there's almost no options to get 50,000 to 500,000. It's too big for most, it's more than you get from most accelerators, competitions, or even kind of like start a new business or impact idea grants. It's more than most people can raise from a crowdfunding campaign or a pre-sale campaign. Most even successful crowdfunding campaigns are in the kind of 10 to 50 range, but it's way less than you can get from any of the serious impact investment funds. They can't invest less than $500,000 or $1 million at a time because of how expensive it is for them to invest. They spend a lot of money in employing expensive people to make laborious decisions about what's worth their investment. And that skews the whole model, leaving this gaping, yawning gap in the middle, as well as a severe lack of capital at the early stages. So that kind of mismatch continues right up to quite a significant scale. And so with all of that as kind of context to the market at the moment, I want to help you think about the different options. We're actually turning this. This was tested for the first time at a conference in Adelaide last week called Impact Chains, turning all these different options into physical blocks that you can stack in different ways to think about different combinations and capital stacks. And so I want to go through the different types of capital, who that capital comes from, why they might be interested in supporting you, and how you might take that capital from them. And too many people start, and one of the great mistakes that a lot of people make is they start with a how. They ask questions like, should I crowdfund? But that in fact is the wrong question, because crowdfunding is just a tool. You need crowdfunding, and as with any tool, the tool shouldn't be the question. You wouldn't pick up a hammer and say, should I use this hammer? That's a ridiculous question. If you're like, I need to build a bench, what tools do I need? I'm like, you need a hammer, because now you actually have a job to be done that the hammer can help you do. And it's the same with fundraising, and in fact, the same with any type of kind of social media as well. People often say, should I use Twitter? I don't know. What are you trying to achieve? Who are you trying to reach? And then depending on the nature of the audience and the nature of the content you want to create, Twitter might be the right answer to the question, where should this be shared and where can I build community? And so in the same way, crowdfunding should be an answer to a question. I'm trying to sell my product to early adopter customers. Crowdfunding is a good way to potentially do that. I want to raise money from family, friends, and fools. Crowdfunding could be a way you do that as well. I actually think crowdfunding, people sometimes accuse me of crowdfunding is my hammer and the whole world looks like nails. The whole world looks like potential crowdfunding campaigns. But still, it's important to think through it in the right order. So first think about the type of capital that is available to you, because that will be affected by some certain core things like what legal structure did you choose. Then think about who is that going to come from. Then think about what is the nature of their engagement, and then we'll think about the how. So let's get onto it. So types of funding, we listed most of these at the start. So philanthropy, that's people giving you money just because they love the idea and like what you're doing, not because they want any financial return. Too often people get caught up in assuming that philanthropy means, big foundations providing big chunks. But, when your family and friends are giving you money through a crowdfunding campaign to start, that's a type of philanthropy as well. They don't expect a return. They're putting money in because they feel an emotional engagement and connection and, aspiration with you and with the cause. And then venture philanthropy is a particular flavor of that, which is not really a different instrument, but it is definitely a different type of conversation, a different type of mindset, which might be more what your family and friends are trying to do. I'm not going to be, don't think that family, donations from your family and friends is your business model, but it might be your startup funds, but it might be your first funds. In a way, that's venture philanthropy. You'll be going to them and saying, I just need this 30,000, 40,000, I just need this to get started. And then I'll be able to, launch my product, sell it and earn revenue that way. But I can't get there if I don't get, that's essentially a venture philanthropy pitch. You're not setting up something versus, I'm setting up a soup kitchen. Could you please donate? And implicit in that is I'm probably going to be coming back and asking for donations 3 times a year. Forever, because that's the model for the soup kitchen. But of course, if you're a social enterprise, that's not your model. So your pitch is almost inevitably a venture philanthropy pitch. I need some philanthropy now to get going. But the good news is then I have a whole model that can sustain the change long term without more philanthropy, creating an amazing return on investment for your philanthropic support. The second is debt, so lending. And again, there are a few flavors of that. The really important one to understand is secured versus unsecured. Lots of secured debt, not much unsecured. Secured means you're putting up a security. So you're taking, the classic is mortgaging your house. Don't do that. But that's what that looks like. That's it. You are putting an asset on the line that the bank or the lender can come and claim if you are not able to repay the loan. Naturally, there's plenty of that. If you have a big capital asset, you can get a loan against it. Where there's again a gap because it's higher risk is unsecured lending. People prepared to lend money to a business that has no other assets to claim. Therefore, in many ways, taking the risk. If you can't repay it, we're just going to lose it. Naturally enough, there's less of that available. And then there's a particular flavor of debt, which is interesting and very common in startups, but more so I think in the kind of commercial startup world, and that's what's called oh my god, everything's out of order. That's weird. Which is convertible, or generally known as a convertible note. And so this, for instance, is just how we've just funded a new platform called Lend for Good. And it's essentially debt at the moment, but it can convert into equity at a future kind of event that is defined. And that means you can avoid having to debate what the valuation of the company is, which is a bit of a like, how long is a piece of string conversation when you haven't yet launched and haven't yet earned any revenue. So essentially everyone agrees to defer that conversation or until a future fundraising round sets the valuation. And at that point, the convertible note holders can decide to convert into equity, normally at a discount from that round. So in our case, 15%. Whatever price is set by our next funding round, the people who took these convertible notes will be able to get 15% more equity than their money would otherwise suggest, or it can convert into a loan at that point. So they have this kind of moment where they can decide which direction that they go, and it gives some of that, it's a mechanism that's thought to be pretty pro-founder because it allows you to essentially, to kind of not have to sell off large chunks of the company at very low valuations. You can try and kind of get to a milestone where you can justify a bigger valuation, even with a discount built in. But equally, it gives investors that optionality at that future point to decide just to get their cash out with interest or to kind of commit to the long-term journey of being an equity, shareholder in a startup business. And then, I don't know why it's out of order. And then equity investment. Excuse me, that's again someone just straight up agreeing to buy a chunk of the company. In order for them to do that, as I said, you have to agree on what's the company worth. If you're putting in $100,000, how much does that get you? Well, that depends on whether you guys have agreed that the company's worth 400,000, in which case we'll get you a quarter, or 2 million, in which case we'll get you 5%. And then there's a version of that which is similar to the convertible note, which defers that awkward conversation, which is becoming increasingly popular, called a safe note, or a simple agreement for future equity. And again, that's essentially defers having to debate a valuation right now, but it's triggered under certain terms in the future. And then the one that I actually am a big fan of, sales. Actually try to get your first funds or very early funds from the people that you hope will be your core supporters going forward, which is people who want to pay for your product or service. At the end of the day, of everything else is just a pathway to that. If you're a social enterprise, your success or failure will be determined by sales at some point. All investment does is give you more time to figure out how to make sales and possibly to make the investments required for that, depending on your industry and context. But when push comes to shove, nothing else constitutes success for an enterprise than having customers. And so I'm a big believer in general that you want to kind of get to that point earlier rather than later. The other reason I think that really matters is because of this risk dimension that we need to talk about, which is investing in social enterprises that don't have sales is naturally an incredibly risky thing. It leaves unproven this entire premise that your entire social enterprise pitch hangs on, which is, I swear someone's going to pay for this. And that's often where, naturally a lot of social enterprises come to grief, is a beautiful impact plan and a nice conceptual framework, but at the end of the day, unable to survive in a competitive market, selling their specific product or service to their particular target market. And so the beauty of sales and focusing on sales really right from the start, rather than focusing on raising investment, is it gives you both those things at once, revenue, but also validation, which often then can turn into future investment. And so keep all of that in mind. And now let's think about who's providing it, because the different types of providers will make a really big difference. So when it comes to philanthropy, there's obviously organized philanthropy, foundations, family offices. In the international context where we sometimes work, aid organizations are often kind of first funders of local social enterprises in different contexts. Again, professional investors, people who have an investor hat on, I want a return on my money. Strategic partners. This is a particular flavor of customer where it's someone who essentially engages where you solve a problem for a single customer who pays you to solve that problem for them, and then you're able to roll out to others. I'll give you a social enterprise example. Lately, there's a new platform called Giveable, which is trying to matchmake between corporates and social enterprise suppliers. And they spent a year building that with Stockland as their first and only customer for a period of time, who essentially won the right, by supporting them early, got right in bed with them and ensured that the product did exactly what they needed to do. Their guess, and it's often true, is that if they can nail that problem for Stockland, that most other big corporates or many other big corporates will have similar needs in terms of being able to sync with their data systems and being able to look across all their different, being able to pull reports that capture their total social impact across a diverse organization, et cetera, et cetera. And I know of other examples in the ed tech space, for instance, or even in, another example I know of is building something that helps with the management of a nursing home, which we might call a social enterprise, helping deliver care more efficiently, built for one large nursing home operator, but with permission once the problem is solved for them, that they could then go and sell it to the rest of the industry. Sometimes after a delay, sometimes they have exclusive rights to use it for a little while. Those 3 Fs we talked about before: family, friends, fools. That generally describes a category of people willing to kind of, who are kind of very engaged emotionally by the story and want to kind of, want to see what happens next, want to be part of that. Accelerators, important in our space. Banks and consumer credit. Your one, Leanne. Oh no, wait, I think that was you, Elise. Bank account. Putting our own funds in or borrowing. This is again something that can be very stressful and not something I recommend, but is a famous pathway, not just for social enterprises. I don't know if anyone's heard, and I really recommend it if you haven't. There's a great podcast called How I Built This, which is interviews with startup founders in the US. And look up the episode with the founders of Airbnb. It's absolutely amazing. They basically built that company on consumer credit. They maxed out something ridiculous like 30 credit cards before hitting the point where they were actually earning sufficient revenue to begin paying them down again. I don't know how, my wife would kick me out of the house if she discovered that I had they had literal binders, those cards that you collect, baseball cards, they had literal binders of credit cards. I just can't even imagine. But there we go, great success story. But that for every success story like that, there's people out there who lost everything pursuing a similar strategy. And then once again, customers, the actual people that you hope down the track will be the fuel that will sustain your impact. How do we get to them sooner rather than later and focus on those early adopters? And so then why might people support your enterprise? Because I think you've got to have real clarity on the emotional response you're going for, and it will depend on who it is and what we're going for in terms of their motivations. So the first is the classic investing mindset. I want to turn my money into more money, and here's an opportunity for me to do that. The second is shopping, a good or service that we want. The third is philanthropy, with or without a tax receipt. Too many people think that philanthropy, the only philanthropy that counts is that is the formal philanthropy with tax receipts to tax deductible organizations. But actually, anything given that is neither for a personal product, shopping, nor for an offer of return, investing, is philanthropic. And then the fourth one that's missing from the economics textbooks is that we express relationships through money. We support our friends, we support our colleagues often. And that can be a really powerful driver for support in the early stage of a social enterprise. That's those people who are supporting your enterprise because they want to see you succeed. You're important to them in some way. They admire you, they like you, you're a friend, your family. And to some extent, it wouldn't matter if you were launching a laundromat or a tie manufacturer or a cleaning service or or a, you know, food delivery service or whatever, they, you know, what they're investing in is you and wanting to see you succeed. And so been really mindful of which of these are we really going for and who from. And I think one of the things that's great about social enterprise, obviously, is that we naturally combine some of these elements. When we're helping people crowdfund, we're always recommending that they really try and combine. We wouldn't take them at all if they didn't have that philanthropic story, you know, making a difference, making a better future, but that they combine that with you know, having a really clear product, even if it's not their core product, you know, creating good rewards and good perks through their crowdfunding campaign. Because obviously, I think there's magic, and the entire social enterprise sector thinks there's a bit of magic if you can help people live their social or invest in their social and environmental aspirations while also solving their personal problems or their personal needs. And then finally, how would we kind of take these funds? Well, how do we get? So there's direct negotiation, you know, going out and pitching to people directly and saying, how about it? And trying to come up with a deal of some sort. There's via intermediaries in our sector who might take you on and then do some of that direct negotiation for you. So people like our partners on Lend for Good, Red Hat Impact. Using platforms, so leveraging a public platform to try and reach out and build a community, like Start Some Good. Via an application process. So that's always convenient, but super competitive. When someone says, hey, we've got money to give, here's how you can apply. That's super handy, right? Rather than having to like find them and directly negotiate. But because that's really handy, naturally, all of these things tend to be very competitive when there's fellowships, grants, competitions, accelerators, and so on. And particularly right now, you know, social enterprise, social entrepreneurship is such a big movement, which is so exciting. But, you know, things like the My Innovation Fellowships have gone from something like 45 applications in the first year 6 years ago to 600 applications or something now, which is partly as the program has got better known and so on, but shows the kind of level of interest out there in these sorts of opportunities. And so talking about how, I want to just talk a little bit about crowdfunding because that's where we come in, and why people are choosing the how of crowdfunding to affect their different goals in this space. You know, the reason I founded Start Some Good while living in San Francisco, which is not a coincidence, because in San Francisco, I felt like I experienced for the first time in my life what a kind of a pro-innovation ecosystem looks like and feels like. And what it feels like is encouragement to try things. And what it looks like is risk-tolerant support. People willing to invest in and support ideas that are not yet proven to work, whether that's angel investors or accelerators or other types of programs. And it even comes down to the question that's been asked. The question that I noticed everyone asking in San Francisco is, you know, what's your idea? And then they want to know, could it work? Tell me about how it could work. But the question I realized, you know, having founded a couple of not-for-profits before that and spent a lot of time trying to raise money for social impact ideas in Australia. And I realized that when it comes to social impact investment, it's a world essentially of all VCs and no angels. And the question we ask is, will it work? Not could it work, but will it work? Convince me it will work. If I give you this money, convince me it will make an impact. And will it work is an anti-innovation question, because it requires, of course, that all the innovation has already happened and we've already figured out, proven what works or not. And that's fine, provided someone is willing to invest in things not yet proven to work, because it almost always, in fact, costs money to prove whether something works or not. You need to do something at some sort of scale or velocity to collect. You need to invest in even the collection of data. And that's really a role that crowdfunding is playing, is essentially providing that angel investor type role. Then in the commercial startup world, angel investors investing their own money, and this is crucial, whereas venture capitalists investing other people's money. So angel investors can invest in whatever they like, you know, and they can be led by whatever they like. They can be led by their passion. They can be led by their values and ethics. They can be led by their curiosity. They can be led by their relationships. I just really like this person. I want to back them. They've been there for me. I'm going to be there for them. VCs can't use any of those things because they're investing someone else's money, and they have to be able to turn around and justify to that person why they decided to spend their money the way they did. So they have to make data-driven decisions. It's not enough to say, I just had a gut instinct and I just felt really good about this. You have to say, well, look at the numbers. It makes sense. And my realization that I had that I guess not really having, despite having kind of been a social entrepreneur my whole life and founding several organizations and raising funds, you don't really know what's going on because you're living your sample size of one. the whole time. And the realization I had was that the whole social sector is a world of VCs with no angels. Everyone's investing someone else's money, and everyone needs to be able to therefore turn around and make a sensible decision around saying, it makes sense, look at the numbers. And therefore everyone's asking us to convince them that it will work. But crowdfunding is filling that gap for things that could work, because what it essentially does is breaks all of it, it reduces the risk. It essentially what they call fractionalizes the risk, to use financial industry jargon. That if we need $50,000 for something that may or may not work, that's a big risk for one person to give us $50,000. But if we can get 1,000 people to give us $50, $50 is not a big risk for most people. Maybe it doesn't work, not the end of the world. It was worth a try. Hopefully we all learned something. It was the friends we made along the way. And so that's the work that we've been doing over the last 10 years, is essentially helping people raise money for things that are not yet proven to work, but could work and are worth trying. And what those funds often represent is not really, people think of crowdfunding as an alternative source of capital. In some ways it is, but what it really is an alternative pathway to validation. That by giving you a more direct path to actually sell and offer your product or service to your potential market, you can then not just raise funds you need, but turn around with that evidence and pitch an idea that now is proven to work for at least some group of people to investors, supporters, philanthropists who may now be willing to give more. I've mentioned the new platform we're launching, and I wanted to mention this. It's not for new launches. Starts and Good specialized in launches and MVPs and so on, pilots. Lem for Good is for growth. You've got a model that is proven to work, but now you need to raise bigger, increasing chunks of money to fuel that growth. It addresses that missing middle for capital for growth-ready impact enterprises in Australia and the Asia Pacific, and it's launching soon. So I'm almost out of time because I do want to give some question time, but I think this is one of my favorite quotes from Simon Sinek. So when people are financially invested, they want to return. When they're emotionally invested, they want to contribute. And I think when it comes to launching social enterprises, we don't really want investors at all. What we want is believers. What we need is a community around us who care about what we're doing, who share our values, and who want to be on that journey of making a difference with us. And however we find that community, that could take the form of investors, but it's not, but particularly in the early days, we don't need someone who just has that financial lens on and is just looking for their financial return. We need people who are really on that journey with us for the social impact that I know is what animates most founders and entrepreneurs in the social enterprise space. And I think if you don't have that alignment, that belief, it's going to make things awkward later on. So I'll just leave you with a final formula that we've developed in 10 years of helping people rally the support they need. And really, I think this formula applies to all launching enterprises. It says here the 5 C's of successful crowdfunding, but I think this is really the 5 C's of successful pitching or successful launching or successful storytelling. What are the elements that you need to kind of essentially tell someone a story so that they will then come with you and take the action that you want. And this is the formula that we teach to crowdfunders and Start Some Good, which is why we have the highest project success rate in cause crowdfunding. And so it starts with clarity. And for a social enterprise, this is where, the challenge is twofold. You need great clarity on your impact model and your business model, or your value proposition, if what you're offering is a product to customers, first customers, which is what I think you should do. A lot of people think that if only they provide enough clarity, that's enough. But often the bigger barrier for people is credibility. Like, yeah, I get what you're saying, but how do I know that you're capable of doing it? So clarity is what allows me to understand what you're trying to do. Credibility is what allows me to believe that you are capable of doing it. And then you need a community. And really what I mean by those carefully chosen communities, really thinking deeply around who is this for and why would they support it? And it may, in the early stages, have different markets. There may be a group of people who support you entirely for the impact because they're very passionate about that cause. There may be another group who just love the product you're creating. And so they get on board as early adopters of that. You need both in the early stages, but both means having the right story to the right community of people, focusing on impact with one group of people, focusing on product with another, and being able to differentiate which is which. Once you know who you're trying to reach, you can figure out how to reach them. So carefully chosen communities, knowing who it's for is essentially the core to your any sort of a marketing or launch strategy. And then only by knowing who it's for can you figure out the tactics, the how of how to reach them, by figuring out what set of channels and what messaging is right. And one of the real mistakes so many social entrepreneurs can fall into is not getting focused enough on their initial niche market. And it's partly because when it comes to social impact, we're encouraged to think big, and we often think in universals. I've got the Sustainable Development Goals on the wall behind me, for instance. They're all universal goals. Quality work for everyone, no zero hunger. That's all very well. You may have a universal goal as part of your big social mission, but in the early stages, you should be focusing on the opposite. What's the smallest viable market you could possibly serve in the initial stages? And how can you focus relentlessly on that specific market in order to build your initial community? And finally, it takes courage. None of this works if you're not willing to get out there and do the work, if you're not willing to share your story. And I know that that's hard, whether you're pitching for philanthropy or pitching in front of investors. It's scary to share our dreams with people who may say no. It's scary to launch a crowdfunding campaign, to put it out there to the world. But if we're not willing to do those things, we're unlikely to make much progress. I'm probably out of time. I was going to talk a little bit more about credibility because it is such an important one. Maybe I'll just leave you with this final thought is just, again, when we're thinking about getting anyone to take that early risk with us, a lot of getting support in the early stages is about overcoming risk. Any support for like a brand new, unproven enterprise is risky, irrespective of what form it takes. But it's worth thinking clearly about these different types of risk. The first is the idea risk. That's the can it work? Convince me that the actual thing is, it doesn't have to be will it work, but can it work? Talk me through it. What's the actual model here? And does that make sense to me? Do I think that's viable? Do I think that's advisable even? Do I share that goal? And a lot of people, again, get caught up on that. I need to convince you that it's going to work. So here's my PhD on how social enterprises can close employment gaps in rural Australia, but I don't want to read your damn PhD. I just want enough signals to know that you know what you're talking about. And often the challenge, again, is not the idea risk, it's the implementation risk. Can this person do it? It makes sense to me, sure. Such and such a business that supports such and, yep, I can see how that could work, but I don't know why, but I can't see, but I'm not sure that I'm convinced that you're the right person to make it work based on your experiences and wherewithal. And then finally, if we're talking about raising funds, the fundraising risk. And this is where I think a lot of people get it wrong, because even when they choose crowdfunding, they choose exactly the wrong platform. Leanne mentioned GoFundMe before, and there's a reason why GoFundMe is not the right platform for most launching social enterprises, and it's because of fundraising risk. And that is, anytime you raise money from investors, there's a minimum you have to raise. If you guys have seen any of the equity crowdfunding campaigns recently, right? They all have a specific amount. We're raising $250,000 to $500,000. And if you don't get to the 250, you don't get to keep it. Why is that? It's because when people are invited to invest in things, they're investing in a plan. They're not just investing in a concept, they're investing in a specific plan, a specific implementation plan, how it is that we're going to take your money and make this happen. And a specific plan requires a specific amount of money. But so many people launch crowdfunding campaigns where they're going to keep whatever money they receive, irrespective of their ability to fulfill the plan. And that's the challenge on a GoFundMe, a Chuffed, an Indiegogo, any of these platforms that use what's called a keep what you raise model. People like to choose them because they like the idea of keeping what they're raising rather than not keeping what they're raising. Of course you do. But that's the wrong way to think about it. It's not about whether you keep what you raise or not. It's what's going to make it easier or harder to raise in the first place. And let me tell you what this feels like. Let's say that I'm pitching my social enterprise to you, and I'm trying to launch a new social enterprise food truck that will employ homeless people in Sydney. And I need $40,000 to get that off the ground. I need to buy a truck and get moving. But I'd really love you to support me. Which model do you think would be more attractive to you? The keep what you raise model, where I get to keep the funds no matter what, or a model where I only get to take it if I reach the goal? Because think about that at a level of promise. What's at the heart of that pitch? At the heart of a pitch, of a keep what you raise pitch, would go a little bit, no one would say it like this, but this is what it really boils down to. Hi guys, I'm launching my social enterprise and I need $40,000 to do that. Would you please support me? And I promise, no matter what, I'm going to keep your money. I can't promise anything else. Can't promise I'm actually going to launch this food truck. Can't promise I'm actually going to create any jobs for homeless people because I don't know how much I'm going to raise. I may or may not make it to 40,000. So that's not a promise, that's an aspiration. But my promise is that no matter what happens, I'm keeping your money. Versus in a more, in a platform like Start Some Good, which has that all or nothing, or what we call tipping point model, the pitch becomes, hi guys, I'm launching this social enterprise and I need to raise $40,000 to launch it. And I'd really love your support. And I promise, no matter what, I will only take your funds if I have the funds to follow through. And so many people shoot themselves in the foot by trying to launch a social enterprise using a charity fundraising model. Because the Keep What You Raise is a charity model. It is designed for charity work where more is more in a very linear fashion. If you're giving out free lunch to disadvantaged people and it's $10 a lunch, then $1,000 100 lunch, $20,000 is 2,000 lunches. It's just however much you raise, you can do a little bit more good. But when you're launching an entrepreneurial venture, you almost always have real world tipping points in your plan. A specific amount of money you need to buy the food truck, to pay a year's rent on the cafe so you can open, to get the first shipping containers worth of product that's ethically made overseas into country to sell, to invest in machinery so you can make enough jams to sell, whatever the case might be. And so for anything entrepreneurial, Keep What You Raise is a completely inappropriate model that undermines people's willingness to trust or support because it simply makes the risks too high. And if you're already inviting people to come with you on the journey and you're trying to overcome these other risks, the idea risk and the implementation risk, we're really big believers in you've got to remove the fundraising risk. And the only way you do that is by making that commitment to only taking the funds if you have enough funds. And that's why all real world investment works like that. You define how much you need for the plan and you don't get to keep it if you don't have enough. And that's how you should approach your fundraising always as well, because your job is to reduce the sense of risk for your supporters, not for yourself. So let me finish up there. That was, I guess, just final things to think about just on this is just before you're looking to fundraise, just really make sure you're clear on both your model and your impact. People often are more strong on one or the other, but it's really important to be really clear and compelling on both. Think a lot about how much credibility you have and how you can create more. You can create more credibility by making more progress before you ask for money and therefore having more evidence and examples, by bringing on board credible partners, and by making the right promises. Using an all or nothing fundraising method is much more credible than a Keep What You Raise. How much funding do you really need? And in particular, just to get to the next step, too many people, I see a lot of people try and raise, launch, I need $2 million to launch this thing because that gives me a 3-year budget, you may not have enough credibility to raise that much money. Think more in terms of what's the next step you got to take. Is it a pilot, an MVP, a test? And how much does that step take? And then what else do you need? People often focus on money very quickly, but often there's other pieces that may be more valuable to you right now in terms of training, mentorship, connections, partners, or support in the design phase to make sure your idea is really punchy by the time you're looking to pitch it and to raise funds. So that's all from me, guys. And hopefully, what have we got? 15 minutes. So I went a little bit past where I wanted to. Apologies, but looking forward to having a bit of a chat now.
So Tom, there's the question there from Tanya, I think. If I scroll back up, is it Tanya? Yep, Tanya. Mm-hmm. So the question is, but not everything is a fixed amount. Keep What You Raise also works if it contributes towards something you will launch regardless, like how much I need to borrow or bootstrap. Are you able to address that one?
But you're asking a stranger to take an absurd level of trust in you to let you figure it out. Of course, your family and friends will. And that's why most people who try to crowdfund on a Shaft Indiegogo will often complain, all I got was people I know. All I got was my existing family and friends supporting me. Has anyone ever heard someone reflect on that? The reason of that, of course, is because what other person would take the deal you're offering, the let me figure it out deal? I'll take your money. I won't be able to do the thing I said because I haven't got the money I said I would need to do that thing, but I expect you to just let me figure it out. Sure. I mean, but would you take that deal with me? Like, you've just met me. I may have a sweet pitch, but would you, if I told you I needed $40,000 to launch this food truck and you looked at my campaign and I had 4,000, would you be like, he'll figure it out? Such a nice young man. You might, but it's a big bar. You're making it really, really hard for yourself to convert other people. So it really comes out, I think, 3 questions to ask yourself when deciding between these models. And the question, first of all, the question you shouldn't ask yourself is, what feels scarier to me? And that's the question that most people use to decide this. They think all or nothing, gosh, that sounds super scary. I might end up with nothing. Keep What You Raise, that sounds much less scary. At least I'll get to keep something. But the fact of the matter is no one else cares. Outside of your family and friends, no one cares what's scary or not for you. Your job as a fundraiser is to make it less scary for me, your potential supporter, not to choose a model that provides you with greater guarantees, but a model that provides me with greater guarantees. Because often what people are doing is avoiding the worst case scenario, right? Because they think to themselves, I couldn't possibly, if I went through this whole experience, I'm not going to end up on nothing. And for sure, that really sucks if that is what happens. But that's only the worst case scenario for you. Can anyone tell me what's the worst case scenario for a donor? Because remember, in the all or nothing, I might try to give you $50, but you don't reach your goal, so I've kept my $50. That sucks for you, but it's like not the end of the world for me. I'm maybe a little bit disappointed. I obviously had hoped your thing would go forward. That's why I contribute. That's why I pledged. But at the end of the day, I got to keep my $50, so I'm not like distraught about it. Can anyone tell me what does make donors really distraught, or supporters, or customers, or any of these, regardless of categories? Anyone tell me?
So sorry, Tom, can I just clarify? So and I'm not familiar with Start Some Good, sorry. So are they actually donating as opposed to you're giving them something in exchange for it?
Depends on the flavor of the style of the campaign. The emphasis
Okay.
on here's what you get versus you should just contribute for your own good.
Yeah.
But what donors, just to answer my own question, what donors really hate, whether they're customers or in either case, whether they're giving you money just out of the goodness of their heart because they want to see, or whether they're giving you money because they want something cool in return, what they really hate is, yes, just nailed it, is failure to follow through. Donors hate that. When they don't, donors, customers, supporters, if they didn't get what they were told. And so what often happens on a Shafter and Indiegogo is someone's like, here's an awesome plan. I need $40,000 to do all this kick-ass stuff. And then you raise $14,000, which for sure is like a nice amount of money, but you can't do a $40,000 project for $14,000. So then either they do some way scaled back version, and some people are like, wait a minute, that's not what I pay. I'm like, hey, I'm not launching the food truck. I'm actually just having a pop-up afternoon. I'm just doing one afternoon, la la la. People are like, well, that's kind of a different thing from what I was trying to support. Or they sit on it trying to figure it out. They're like, okay, I'm 14,000. I need another 16. Wait, is my math off? I need another 26. So then they start applying for grants and they start applying to get into accelerators. I'm going to find the other 26. But that ends up taking a really long time. And so 6 months later, nothing has still happened. And I'm like, what the hell has happened here? I gave you my money and you've done nothing as far as I can see. And so I think I mentioned earlier the three questions to think about. But one is, who are you trying to raise the funds from? And essentially, how much credibility do you have with them? So let's say if my kid's soccer club was doing a fundraiser and they were trying to refurbish 3 fields and the change room and they needed $40,000, but they only raised 10, I would expect them to keep it. I would expect them to use a traditional charity. You keep whatever you raise, and I'll trust them to choose whether it's 2 fields and nothing else, or just the change rooms, or because we have a relationship with them, so I'll let them figure it out. But if it's a brand new, it's a social enterprise making soccer balls as an employment, to employ refugees, I might not have the level of relationship with that new organization, that new founder, that I will let them just figure it out with my money. The second is, does it have a real world tipping point? So again, most charity projects are kind of perfectly modular. You can kind of just, if you're just giving stuff out, you can just give out more or give out less based on how much you can pay for. But if you're launching a business, it's normally not so modular. There often is a very specific real world tipping point that we would call it. In the case of my food truck, I got to be able to buy a truck. And if I have half the money for a truck, I don't just get to create half the impact. I don't get to launch half a food truck, creating half as many jobs. I end up with nothing. If it's any kind of a business that involves import, you almost always need to get a shipping container's worth. If you're launching a fair trade fashion company, you can't order 71 dresses. You need to order 7,000, or else they won't make it for you at all. So you need, you need $50,000 to have a shipping container's worth initially. Or if it's a cafe or a shop, you need a year's rent or 6 months rent, or else you can't move in, and you need to stock it and whatever. And so in those cases, we think the only kind of credible thing is to align the mechanism with that real world scenario. that I need to get to this amount. That also really helps for the clarity and the credibility of the pitch, that there's a real, like, I get to this happens. There's real certainty around that and real commitment around getting to there. And then the third question is just how risky is it? So if you're, we think there's kind of thinking about those different types of risks. So idea risk, is it a genuinely innovative idea? I'm making child orthotics using 3D printing. That's a really new idea. No one's done it before. There are implementation risks in anything that's new. Or often, and then often there's risks around the founder, like maybe someone else has done it, but I haven't done it before. Food trucks are not a new idea, but I have no background in hospitality. I've never I've never done a food truck before. I haven't worked with homeless people. You may well look at that and go, cool idea, Tom, but I'm not convinced you're the right person to launch that idea. And I'm like, no, I am. I swear I am. I'm so ready for this. And so if you're trying to kind of get people to take that risk with you on either case, because what you're doing is innovative or it's pushing beyond your personal experience, we think it's part of the game is to try and de-risk wherever you can for those supporters. And we think the most powerful way you can de-risk any kind of early funder is to give them, of course, certainty as to what happens with their funds. That's what all funders are looking for. And the only way you can do that via crowdfunding is to commit to raising a certain amount and only taking people's funds if you reach that amount. I will say one thing about this model, because of course everyone's nightmare scenario with an all or nothing, or what we call tipping point crowdfunding campaign, is what if I get just close, if I get like so close and then don't make it? I'm trying to get 40 and I get 37.5 and then, or 36 and fall just short. And the fact of the matter is that literally never happens. And I don't think it ever could happen, because the easiest $4,000 to raise in a $40,000 fundraiser is the last four. And so in order for you to be at 36,000 in this hypothetical example, you've already gone through all these much harder milestones. Like 0 to 4 was harder, 4 to 8, 8 to 12, 12 to 16. You've made it through all those more challenging milestones. And now you've got this little piece left. And if your community was so blasé, your potential supporters, your potential customers were so blasé that they would let $36,000 in funding just evaporate, you wouldn't have $36,000 in pledges. And so the fact that in our experience that everyone who's ever made it at least halfway with a week to go has made it. Because there's something kind of magical about being on that downward slope when you have this money hanging there that is at risk of being lost. There's actually this there's this human piece of human psychology called loss aversion that people are much more, I actually think that's just clarity preference. In terms of our model, people need real clarity, and we have much greater clarity on things that are than on things that could be. So if I know exactly what the local library means to me, whereas if I didn't have a library but we were considering building one, I'd have to imagine what a library could mean to me. But how that manifests is people tend to work harder to preserve what is than to invest in or create what's new. That's something we're all up against as social entrepreneurs. We're all trying to create something that's new usually, and we're trying to push against that. Part of the kind of subtle magic of all or nothing crowdfunding is it takes something that's quite abstract potentially, I'm doing this new social enterprise and it's going to be so cool, into something that everyone understands and is quite tangible, which is I have $36,000 on the line and I now need another 4 or I'm going to lose it all. And everyone in the world understands how urgent and important that is. And urgency and important is crucial for any type of fundraising. And so the increased urgency, increased importance, increased meaning of all or nothing fundraising tends to get people who can even come within striking distance of that goal to the goal. The other great outcome, finally, didn't mean to make this one just a whole pitch about all or nothing versus keep raise, but it creates more social capital in this funny, subtle way. Keep what you raise fundraising is kind of an individual decision. Like you're raising money, I give you $50, you get the $50, no matter what happens, I'm done here. I've done my part, good luck. Whereas with all or nothing, I give you $50, but I haven't actually given you $50. I've just made a pledge to $50. And if in order for you to even get my $50, you need to reach this goal. So if I want you to have my $50, if I want to be supportive at all, it's not enough for me to give. I have to help you get to the goal. And then when the goal is achieved, people feel this real sense of collective accomplishment of, look what we did. I was part of this community that was capable of making this amazing thing happen. And that creates this incredible amount of social capital and kind of stickiness, as it's called in the marketing profession, with your customers and supporters, because they feel like they're really part of that with you.
Tom, hello. Quick question. So 2 things that I want to quickly mention. So let's go first. So is what you're talking about similar to, let's say, a Kickstarter where you're offering rewards and perks and things like that, but you've still got to hit a tipping point in order for people to get the perks? Is it a similar mindset?
No, exactly the same. We were really inspired by Kickstarter, actually, and it's why we're a bit different. If I have a graph in a different. Actually, let me show you. It's even worth doing just quickly, just because it's interesting because we were really directly inspired by Kickstarter. You know, I was in San Francisco and I was thinking a lot about how we support kind of innovation and things that are new and emerging, and how the social sector is historically bad at that. And I thought, who's good at supporting innovation? And at the time, I was like, Kickstarter's really, you know. And I thought that they were solving a really similar problem, but for creative artists, which is how do you go around gatekeepers? You know, the creative industries used to be a world entirely of gatekeepers, you know, say record label executives. None of the rest of us got to hear music until a record label executive decided that it was worth hearing. And they got it wrong all the damn time, constantly. You know, there's a famous story of how many record labels knocked back the Beatles. There's something like 89 or something. How many Beatles did we lose out on in the 20th century because they got dispirited after the 88th rejection and didn't move on to the 89th, you know, and why were they knocked back? Because they didn't sound like everything that came before. So gatekeepers are good at like reverse pattern matching. Hey, that sounds just like the thing that was successful last time. And that's kind of the equivalent of has a proven impact model, has a proven popularity model in the creative arts. But of course, you can't support the new or innovation that way. And so Kickstarter was helping creative entrepreneurs go around those gatekeepers and produce art. But you know, as with launching a social enterprise, you normally can't just make any amount of art for any amount of money. It's not modular. It costs, you know, you need a certain amount of money to book the studio. You need a certain amount of money to book the producer to actually make your music sound good, or whatever the case might be. And so we were very directly inspired by them. And it put us in a, I'm just going to share my screen again quickly from a different proposal, but it's put us in this almost unique quadrant. If you were to look at all the crowdfunding sites and divide them, kind of in these very broad brushstrokes, but kind of people who are focused exclusively on social good or primarily on social good, and then kind of everyone else, creative, business, and then divide into these two models, keep what you raise versus tipping point. Most of the platforms that kind of popularized the crowdfunding model in the creative industries were all or nothing platforms. Kickstarter in the US, Possible in Australia, Pledge Me in New Zealand. But as people adapted that model for social good, they pretty much all chose this charity model of keep what you raise. And it's because most of them are from a more charity background. I am as well, mostly I was always in the not-for-profit sector before this as well. But it's because also our mission is a little bit different. Their mission is almost always to get more money to good things, to good causes, which is, you know, a perfectly good mission and you know, one that we share in part. But our core mission is to increase the pace of innovation for social good. So we're not just thinking about how do you help your Red Crosses and your Oxfam raise money, but how do you help the emerging social entrepreneur who hasn't done it before, but has a great idea, often derived from personal experience or lived experience around how to make things better. And when it comes to supporting innovation, we thought that the all or nothing model was clearly proven to be more effective at that. So yeah, it's just like the Kickstarter model, really. But even if you don't necessarily offer direct perks, you might just be offering social impact, but being able to specify and commit to the social impact you're creating with the funds you're requesting is still, we think, a much more effective way to go about funding, particularly something that's new, something that's not my kids' soccer club that's been there for 40 years and has an established community of participants.
Thank you so much. Now, Tom, if people want to find you, apart from Start Some Good, you're giving a talk to, oh God, what day is it today? Tuesday.
Thursday. On Thursday, we're doing another event with QSEC, specifically on crowdfunding, and also with Tony from Food Connect, who's done a big equity campaign. We're not experts at equity. We have a pre-sale. Someone asked there, is it good product launch? That's actually our focus on the Start Some Good platform, is particularly when we work with social enterprises. We're big believers that social enterprises should launch how they expect to live. Again, one of the things I think a lot of people do is they run crowdfunding campaigns that is, help me launch this social enterprise. Whereas what we recommend is use a crowdfunding campaign as a way to launch your social enterprise. And what does that look like? Not saying, hey, I'm launching a social enterprise and I need your support to launch the enterprise. It's, I'm launching a social enterprise and you can buy whatever it is right now. I may not deliver it for 3 or 4 months because I need to take your money, invest in production and so on, but you're buying the thing, whatever the thing is. Lots of people will just give philanthropically at the same time. Even when people offer rewards, about a third of everyone clicks the no reward button, because that's your family and friends who just want to support you potentially. They're like, don't worry about sending me the jar of honey. I don't even like honey, but I want to see you succeed, or whatever the case might be. So we're really big believers in that. But if you want to dive a bit more into crowdfunding, whether it's pre-sale, philanthropy, equity, or this new debt platform we're launching, we're going to be talking about stuff specifically at, God, what is it your time? We're an hour different. 6 p.m. for me, 5 p.m. for you on Thursday.
So I've put the link in there, but if you go to the QSEC events page, you can find the link there. So it's a 6-weekly, this is session number 4, I believe, out of 6 sessions. So they're all available. Thank you so much. So if you do have any other questions about crowdfunding specifically, I highly recommend jumping into the Humanitix link and going to the event on Thursday night. I think it's 5 p.m. for us.
And if anyone wants to, obviously, Start Some Good is startsomegood.com, and we're at Start Some Good almost everywhere. Facebook.com/startsomegood, LinkedIn/startsomegood, Twitter, Instagram. For me personally, my main public social networks are LinkedIn. You're very welcome to connect with there. I share kind of a few posts a week about stuff I'm thinking and learning. And then Twitter, I'm Tom JD.
Lovely.
Right up there.
And for those of you who do want to hang around, I'm going